If you've ever felt like Wall Street is this super complex, noisy place where only the pros can win, well, this explainer is for you. We're going to cut right through all that noise to find a clear, simple path for investing. Oscar Wilde absolutely nailed it with this line. It really gets to the heart of the biggest challenge in investing. See, it's not just about the numbers you see flashing on a screen. It's about understanding the huge difference between what a stock costs, that's its price, and what it's actually worth, that's its value. And trust me, getting this right, that's the whole game. So, how do we figure out what a stock's price should be? Well, it turns out the entire world of investing is basically this huge battle between two completely opposite ideas. Let's break them down. Yeah, this is the big one. This is the question every single investor is trying to answer. And the theory you believe in, well, that's going to define your entire strategy. All right, so the first theory, this one's the logical, analytical approach. It's called the firm foundation theory. The idea here is that every stock has a real, calculable value, like an anchor of worth, that's based on the actual business behind it. It's the company's bedrock value. And this idea of intrinsic value, it's not just some number you pull out of thin air, right? It's a figure you can actually calculate by digging into a company's financial health and figuring out how much cash it's going to generate for its shareholders down the road. So what do you do with that? Well, it leads to this beautifully simple strategy, one pioneered by legends like Benjamin Graham and, you guessed it, his most famous student, Warren Buffett. You do the hard work, you figure out a stock's true worth, and then you just patiently wait to buy it when the market offers it up at a discount. It sounds so simple, but doing that hard work, that's the tough part. Okay, now let's do a complete 180. The second theory is called castles in the air, and it basically throws all that cold, hard analysis right out the window. It says value is purely psychological. A stock is worth whatever the crowd thinks it's worth, based on nothing more than optimism, hope, and dreams. Yeah, forget the spreadsheets. This is all about what's going on in people's heads.
The famous economist John Maynard Keynes summed it up perfectly. He said the goal is to figure out what average opinion expects the average opinion to be. It's like you're not trying to predict what a company will do. You're trying to predict what everybody else is going to predict the company will do. It's a game of getting ahead of the crowd.
And history is just littered with wild examples of this. Back in 17th century Holland, people went nuts for tulips. Speculation drove the price of a single tulip bulb to insane levels. We're talking more than the cost of a house. I mean, think about it. People weren't buying flowers. They were buying the hope that some other person would pay even more tomorrow. And when that hope disappeared, so did their money. And it gets even more absurd, believe it or not. A century later, during something called the South Sea Bubble, people were throwing money at companies with these ridiculous business plans, including, and I'm not making this out, a company for extracting sunlight from cucumbers. When price completely detaches from reality, people will believe literally anything. And look, don't think for a second that it's just, regular folks who get caught up in this madness. Sir Isaac Newton, one of the smartest people who ever lived, the man who discovered gravity, even he lost a fortune in the South Sea Bubble. He understood the laws of the universe, but the madness of the crowd, that proved to be way more unpredictable. And hey, this stuff isn't just ancient history. Back in the 1980s, a teenager named Barry Minkow had Wall Street convinced that his little carpet cleaning business was a billion-dollar empire. The story was amazing, the hype was unbelievable. There was just one tiny problem. It was all a lie. A massive Ponzi scheme. The castle was built on nothing but air. And boy, did it collapse. So you've got these two huge forces, right? The logical search for value and the pure, unadulterated madness of crowds. So what happens when they smash into each other in the real world? Well, the result is something nobody really saw coming. So on Wall Street, you've basically got two camps. You've got the technicians who study charts, trying to predict that market psychology. They're the castle builders. And then you have the fundamental analysts who study financial statements to find that intrinsic value. They're the foundation builders. So who wins? And the answer, which came from a ton of academic research, was pretty shocking. It's kind of neither of them. Not consistently anyway. With thousands of brilliant analysts trying to find value and thousands of traders trying to guess the next trend, any new piece of information gets baked into a stock's price almost instantly. This whole battle makes the market incredibly efficient. And what that means is, honestly, It's a huge deal. If all the information we already know is already in the price, then the only thing that can make the price move is new information, which by definition is unpredictable. A stock's future path is essentially a random walk. Okay, let me put it this way. Imagine 1,000 people enter a coin flipping contest. After 7 rounds of flips, you'd expect about 8 people to have flipped heads every single time, just by pure chance. Now, would you look at those 8 people and say, wow, you are geniuses at flipping coins. Here, manage my life savings. No, of course not. It's just luck. And the stock market creates winners in much the same way. Which, of course, brings us to the billion-dollar question. With all their fancy degrees, their data, their experience, can the pros, all those analysts and managers, actually deliver better results than just, owning a little bit of everything? The answer to that question points to a winning strategy that is so powerful and, believe it or not, surprisingly simple for any regular investor. So let's get into how you can actually use this stuff. I mean, just look at the data. It's not even close. Over the long haul, a simple, unmanaged fund that just buys and holds all the stocks in a big index like the S&P 500 has pretty much smoked the vast majority of those highly paid pros who are supposedly the experts. So what's the big takeaway here? What's the winning strategy? It's really just 2 simple principles. First, diversify. Don't try to find the needle in the haystack, just buy the whole haystack. And second, use low-cost index funds. Own the entire market instead of paying some expert a huge fee to try and usually fail to beat it. And the best part, it's so simple. This do-nothing approach of just buying and holding, it's effective, it's cheap, and it's way more tax efficient because you're not constantly buying and selling. Sometimes the smartest thing to do is absolutely nothing. And if you're still not convinced, listen to this. This is the ultimate mic drop. Towards the end of his life, Benjamin Graham, the guy who literally invented the firm foundation theory, admitted that the game had changed. Even he had to admit that the market had gotten so competitive, so efficient, that he basically said, yup, I'm on the side of the efficient market folks now. So where does that leave us? It brings us to one final, really important thought. The market is mostly efficient, but our own human psychology, not so much. The strategy is simple, but actually sticking to it is incredibly hard, because we're wired to chase the hot stock or panic when things go down. So the real question isn't, can you beat the market? The real question is, can you master yourself?